A third strategy that you can use is avoid buying a mutual fund right before the distribution. Buying the dividend is another common investment mistake. This happens when someone buys a mutual fund shortly before it pays a year-end distribution. At this point, the fund's share price will drop by the exact amount of the distribution on that ex-dividend date, and the investor hasn't enjoyed those gains or gained anything. They still receive a tax bill as if they'd earned the profit. I want to give you an example to make this a little bit easier to understand. Let's say an investor, Alex, plans to invest $10,000 in a mutual fund in December. If Alex buys the shares the day before the distribution, he receives an $800 taxable distribution, and the share price drops by 80 cents. His account is still worth the same amount afterward, but now he owes taxes on the distribution. On the other hand, if he'd waited until the day after the distribution, he would have avoided that entirely. So when investing in mutual funds late in the year, especially around October or later, it's really important to check the fund's record date and ex-dividend date. If a large distribution is approaching, waiting a few days will help eliminate that unnecessary tax bill. Something to be aware of also is that sometimes cap gain distributions can happen in the middle of the year, in the summertime. It's always just important to check into the mutual fund's ex-dividend date and any other information that you can find as you do your due diligence.